Have you ever stared at your utility bill and just wondered, why is this so complicated? I mean, why isn't buying electricity as simple as buying, say, a cup of coffee? Well, it turns out there's a pretty fascinating economic story behind all that complexity. So let's dive in and really unpack why your energy bill looks the way it does. Here's the game plan for this explainer. We're going to start with the ideal textbook model of how a market should work. Then we'll see why energy just completely shatters that model. From there, we'll dig into this weird idea of a natural monopoly, the massive headache it creates for policymakers, and finally, we'll look at the clever solutions that lead to the very bill you get in the mail. All right, first up, the perfect market model. See, to understand why energy pricing is so weird, we first need to get a clear picture of what a normal market is supposed to look like, at least in the clean, simple world of economic theory. So picture this. In a standard economics textbook, you've got this ideal market with tons of buyers and tons of sellers. No single company, no single person has enough power to actually influence the price. They're all what's called price takers. They just have to accept the going rate. And the ultimate goal in this perfect world? It's something called competitive equilibrium. Think of it as the market's sweet spot. Producers are making as much profit as they possibly can, and you, the consumer, are getting the most satisfaction or utility for your money. And the result of all this? The absolute best, most efficient outcome for society as a whole. It's beautiful.
And this perfect state is all built on one simple golden rule. The price of a good should equal its marginal cost. Now, in simple terms, that just means the price you pay for one more of something, one more widget, one more coffee, is exactly what it costs to make that one extra unit. Beautifully simple, right? Well, hold that thought.
So we've got our foundation, that simple rule. Now, in Section 2, we're going to see why energy markets are just a completely different beast. This is where we leave the neat and tidy textbook world and get into the messy reality of power grids and utility bills. Which, brings us right back to the main question. If the ideal is so simple, price equals marginal cost, why isn't your electricity priced that way? Why can't we just pay for the exact cost of the power we use and call it a day? Well, it really boils down to three huge things that make energy different from almost anything else you buy. First off, what economists call the indivisibility of capital. You can't just build half a power plant, right? The investments are enormous and come in these giant lumpy chunks. Second, a lot of our energy comes from exhaustible resources. When you use a barrel of oil, it's gone forever, which adds a whole other layer of cost. And third, asset specificity. A power plant can only ever be a power plant. You can't decide one day to start making cars with it instead. Now here's the real kicker, the big consequence of all those factors. The cost to produce just one more kilowatt hour of electricity, that's the marginal cost, is actually super low. But the average cost, which has to include paying for that billion-dollar power plant in the first place, is way, way higher. So if we only paid that low marginal cost, the utility company would go bankrupt, fast. And that massive gap between the marginal and average cost leads us straight into our next big idea. In Section 3, the natural monopoly problem. It's this very strange situation where having just one company in charge is actually the cheapest, most efficient way to do things. A natural monopoly happens when the setup costs for an industry are so mind-bogglingly huge that it makes absolutely no sense to have competition. Just think about it for a second. Would you want 5 different companies all running their own sets of power lines down your street? Of course not. It's so much cheaper and more efficient for just one company to build all that infrastructure for everybody. Now, the fancy economic principle behind this is called subadditivity, and it's summed up in this little formula. Don't let it scare you. All it's really saying is that the cost, that's the C, for one single firm to produce the total amount of stuff, that's Q1 plus Q2, is less than the combined cost of 2 separate firms trying to do the same job. And this is the bottom line, what it all boils down to. One company, one set of power lines, one power grid. It is just the cheapest way to get the job done. And that, my friends, is a natural monopoly. But it creates a massive problem. So you might be thinking, okay, if one company's the most efficient, what's the big deal? Well, that brings us right to Section 4, the public policy dilemma. How on earth do you regulate a company that works best as a monopoly without letting it abuse that power and charge you whatever it wants? It's a fundamental trade-off. Regulators are basically stuck between a rock and a hard place. On one hand, they could force the company to use marginal cost pricing. That's perfect from an economic efficiency standpoint, but the company loses a ton of money and goes bankrupt. Or they could just let the company act like a true monopolist and charge whatever it wants. The company survives, for sure, but we, the consumers, get hit with unfairly high prices. Neither of those is a good option. And let's be crystal clear about this. If you take that perfect market role and apply it to a natural monopoly like a utility, the company simply cannot cover its huge fixed costs. It would need a massive government subsidy just to keep the lights on. So how do we get out of this mess? Well, that brings us to our final section, number 5, clever pricing solutions. These are the real-world strategies that regulators and utilities came up with to try and find a workable middle ground. Okay, the first and by far the most common solution is what's called the two-part tariff. And this should look very familiar because it's probably how your own bill is structured. It's a system that has two parts: a fixed monthly fee that everybody pays, no matter how much energy you use, and then a separate charge for every unit of energy you actually consume. This example here just illustrates it perfectly. See that fixed fee, that $5 a month? That's not really for the energy you're using. That's your small contribution to help the company pay for all its massive fixed costs, the power plant, the grid. Then, the per unit price you pay for consumption can be set much closer to the efficient marginal cost, which encourages you not to waste power. It's a really clever hybrid solution. Now, a second, even more advanced strategy is something called Ramsey pricing. This gets a little more complex. It's all about charging different prices to different groups of customers based on how sensitive they are to price changes, what economists call their price elasticity of demand. In essence, Ramsey pricing really just boils down to this. The more you absolutely need the service and the fewer alternatives you have, the higher the price you'll pay. So for example, a huge factory that has to have power to run its machines might pay a different, higher rate than a residential customer who has more flexibility. It's basically a way of making sure the company covers its costs while causing the least amount of economic pain overall. So that's how we got to the bills we have today. But it also leaves us with this one final massive question for the future. As we race to electrify everything, our cars, our homes, and shift to renewables like solar and wind, sources where the marginal cost of one more unit of energy is literally zero, do these pricing models that we've spent 100 years perfecting still make any sense? Or is the entire foundation of how we pay for power about to be reinvented all over again? That right there is the next chapter in this incredible economic story.